Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. A deal to reopen the Strait of Hormuz is gaining traction as Qatar drafts an interim proposal and Washington and Tehran signal progress. Oil markets steady as supply concerns ease. India's central bank is expected to keep rates unchanged as policymakers assess whether oil-driven inflation pressures become more widespread. Asian stocks are climbing as Samsung and SK Hynix lead a renewed AI rally. Investors are also weighing after-hours declines in SpaceX and AMD following mixed AI outlooks. Pakistani fintech Abhi is preparing an IPO for its microlender as it expands into gold-backed lending. We're going to speak with CEO and co-founder Omair Ansari about the company's next phase of growth. Our top story today, oil prices are steadying after a two-day decline amid rising hopes for de-escalation in the Middle East. Brent and WTI both trading below $80 a barrel after losing more than 10% in the prior two sessions. Axios is reporting that the US, Iran and Oman are closing in on an interim agreement to reopen the Strait of Hormuz, and they say the deal could be announced as soon as this Wednesday. Qatar earlier said a proposal had been drafted. For more on this, let's get to our Middle East correspondent, Abhi Abu Omar in Dubai. So, Abhi, what details do we know about this plan?
Good morning, Paul. There's a lot going around this morning about the details about this plan. What we understand and what we've been reporting on over the past few weeks is it really boils down to the Strait of Hormuz. According to a lot of American officials, our own sourcing, it comes down to reopening the Strait of Hormuz in some way, shape or form. Now, we've reported over the past week or so, Paul, if you remember, about Oman and Iran being in discussions to open a middle pathway in the Strait of Hormuz to get ships and vessels to move a little bit more freely in the Strait of Hormuz. Yesterday, we also reported, citing sources familiar, that Iran could be open to the idea of European nations getting involved to demining the Strait of Hormuz. Now, that is something that it was vehemently opposed to over the past 5 months or so. But what we report is that behind closed doors, Iran has softened up to the idea of getting other nations involved. We'll hear more about whether that is in fact going to happen. But as you mentioned, according to plenty of American officials, a deal could be announced as soon as today. You also mentioned Axios that moments ago, or about an hour ago, reported that that deal could be announced as soon as Wednesday, which is today, and essentially it will be about the Strait of Hormuz and reopening that. Qatar mediators, what they say is that the language in the draft that they had pinned down to American officials between them and Iran will really be about resuming talks. And Paul, what we reported on over the past month or so, especially since that MOU was signed in Switzerland, the deadline for that MOU is very close. It is this month. That all, of course, has left the window, if you were. And now we're looking at resuming talks between Iran and the United States. But the concessions that we reported on, including the nuclear component, those have taken a back seat for the time being. For now, we are looking at the Strait of Hormuz, other waterways, of course, but mainly the Strait of Hormuz, and resuming the much-needed tanker movement there.
You mentioned other waterways because there has been some focus on the Red Sea, particularly around the aptly named Gate of Tears. But we're hearing that Saudi Arabia and the Houthi rebels may be in talks as well. What more do we know about that?
That's also true. So we also reported, citing our sources, that Saudi Arabia is holding discussions with the Houthis in Yemen. That is, of course, the Iran-backed Houthis in Yemen, using Oman to mediate. So Oman really being a neutral player in the region, in the GCC, mediating between Iran, mediating between the United States, and now between Saudi Arabia and the Houthis in Yemen, who have been striking each other over the past month or so, Paul. So a parallel aggression, if you were, in the Red Sea, which Saudi Arabia has resorted to throughout the course of this war to get its shipments across to the world. And now that even is under attack, or under the threat of getting attacked by the Houthis. So we're reporting that Saudi Arabia, behind closed doors at least, or in private, is resorting to diplomacy. Nothing final yet. The aggression, or the risk of the aggression, still looms around in the Red Sea. That is another waterway that is at risk in the Middle East, possibly having an impact on those energy prices in the foreseeable future. But for the time being, we're reporting a return to diplomacy on that front as well.
All right, our Middle East correspondent, Abhi Abu Omar in Dubai, thank you. Now, we're also keeping an eye on US Treasuries as falling oil prices curb expectations for Fed rate hikes. We've got the 10-year yield well off where it was at the end of July, where it did break through 4.7. At the moment, the yield now 4.59. We've had a bit of a rally in Treasuries on this good news. The yield on the 2-year note is now at the lowest level since July 20. So the US Treasury yields reflecting that encouraging situation in the Strait of Hormuz. Let's get a bit more perspective now with Carol Lai, Portfolio Manager and Senior Research Analyst at Brandywine Global. Manages over $60 billion in assets. Carol, thanks so much for joining us today. And, as I mentioned, we do have yields coming off those peaks we saw about a week ago, largely thanks to the softer oil price. But we have been here before, haven't we? How cognizant of you are possible bumps in the road?
Yeah, so thanks, Alan, for having me on. I mean, our outlook really for the rest of the year, just to put all this into perspective, is really that, we, since the beginning of the year, when we came into the year, we have been seeing, much more resilient global growth because, there was a lot of policy accommodation in the past 1.5 years. You see that all in like credit growth, all picking up, global PMIs as well. So it's not surprising that global bond yields have been going up higher. And that has been our view. But it has really been a lot of it driven by real yields. So our view really is that, going forward, global bond yields can remain higher for longer. But in the interim, obviously, as we can see, the Iran war or the cessation of Iran war is actually helping oil prices to come down. So we do expect, that global bond yields can come off a couple more basis points, perhaps. We are actually a bit more than also concerned that going forward, if there's any weakness in U.S. data, of course, it's all very resilient now, but if there is any weakness in, global data, what happens is that then you could have a bit more of a rally in global bond yields.
Yeah, maybe we can talk about data in a moment because we do have jobs numbers coming up out of the US. But I just want to bring your attention to the longer end of the yield curve there. We've got a 30-year still above 5.15. To what degree do you feel like this is a bit of market commentary around the performance of Kevin Walsh as Fed chair?
Yes, I think, global bond investors or bond yields tend, they tend to be what we call bond vigilantes. So the fact that the Fed did not hike rates, the market in itself is trying to signal to the Fed that there should be higher rates going forward. Now, the issue here is that, that there are a mix of factors really on the longest end of the curve, like you said, the 30 years. There's both the real yields that have been going up, and in fact, it's the real yields that have been going up. There's also a fiscal, kind of term premium, and that's really dependent on the fiscal, right? That's what's being priced in. So the fact that the Fed did not raise their rates, the bond vigilantes are really pushing the bond yields up so as to press them to hike rates at least once from here. So that's where we are seeing things happening.
What's your assessment of the Fed's comm style at the moment, communication style, or lack of, particularly when it comes to commentary around the inflation fight? Is this having any impact on your decision-making at the moment?
I mean, well, the issue here really is that the Fed has changed the way it is managing the market. So previously, with previous Fed governors before Wash, basically the Fed was guiding the market. But now Wash wants the market to kind of give the signal to the Fed. And in fact, he has been saying that, the market should be playing the ball and not the referee. I think it does add a lot of noise. It is definitely it is providing more volatility into the market. What happens sometimes is that it results in bond yields overshooting itself, which is possibly what we could be seeing here now. The market tends to sometimes run on its own, and the Fed eventually has to come in to kind of rein in the market. But I don't think that's what we're seeing as it is yet.
Does Kevin Walsh kind of have a point, though? Because, rates have been so low for so long now. Have markets got used to this kind of commentary from the Fed? And, maybe that's not what normal actually looks like.
Yes, indeed, that is true. If you look at the yield curve, while it has been steepening, it's not as steep, right? So you have a very good point, Paul. It could be that the Fed or Wash wants the yield curve, in fact, to be steeper going forward. But at the same time, I think they are also quite cautious, right, about having 30-year yields that are too high. In fact, we are very near that kind of levels that we saw previously where, the Fed, the Treasury would start reacting, because I don't think they really want much higher yields from here, because it does add to the interest expense that the US is paying for. If you look at the housing market, it has also been, kind of on the weaker end because they are housing prices are interest rate sensitive. So it's at this moment, it is quite unclear as to where Wash really wants yields to be at. It's quite confusing, actually, to the market.
Well, what are you expecting from the Fed for the rest of 2026? Is there a possibility that we don't get tightening at this point?
Well, I think going forward, there are a couple of factors that are in play here, right? The first, I think we need to take note that Wash did say that, the market is tightening financial conditions for him already, for the US. So that's the first that we need to take note of. So, and then the second thing is that inflation, although it is above 2%, it has been stuck there for a long time. And that's why the market expected them to be hiking. Going forward, there are some signs that actually inflation is on a disinflationary path from here. The second thing as well, or really the last thing, is that Wash is still, the 5 various committees are still re-looking at how inflation should be measured, what is the best way, that we should term what inflation is. So given all those circumstances, there is a risk that, the Fed would raise rates once, or in fact twice maybe, but I mean, they do sound that, Wash doesn't sound like he really wants to raise rates overall. And the market has already priced like 2 to 3 times in rate rises. So there really isn't a lot of reason for them to really be raising rates more aggressively here.
I'd like to get your view on this joint intervention that we saw as well between the US and Japan in supporting the yen, which has kind of worked. Here we are at 157.39, way better than we were a week ago in terms of yen strength. President Trump says they were helping out Japan with the weak currency, but I'm wondering to what degree you feel the US was motivated by concerns that rising Japanese yields might have some undesirable spillover effects for US yields.
I mean, that is true because at the end of the day, the U.S. is more concerned about their Treasury yields. And there could be that spillover effect via the weaker yen, especially if, for example, we get very weak, the yen goes on unchecked, it goes on to weaken further. It results in rising inflation in, Japan. And then one day the BOJ would be forced to kind of raise rates very rapidly just like how we see what emerging markets do. I'm not saying that Japan is emerging markets, but that's typically how it works. And then when the BOJ has to raise rates very suddenly, it does result in JGB yields going up higher, and then there is what we call a sudden stop, and it results in a change in capital flows globally, resulting in perhaps the Japanese having to sell their treasuries and then repatriating back into Japan. So I think the US is quite concerned that effect could come in, right, if they don't put the yen in check now.
Now, we saw a somewhat weak 10-year auction for JGBs this week as well. JP Morgan saying avoid JGBs at the moment because the Bank of Japan is so far behind the curve. Is that a position you agree with?
Yes, to some extent. The BOJ, as we all know, has been behind the curve. If you look at real policy rates, they are so negative. So there's a lot more space for the BOJ to catch up in terms of raising rates. The issue here is that obviously the BOJ wants to do it at a more controlled and measured pace, and then eventually reducing that real interest rate gap that we are seeing. So in the meantime, while the BOJ is still not quickening their pace in terms of a rate rise, it's very difficult for the super long end, especially facing a lot of supply-demand issues. It's quite difficult for super long end yields to, come down. But eventually, we'll probably get there. I think it's a matter of timing.
All right, Carol, thanks so much for your analysis today. That's Carol Lai, Portfolio Manager at Brandywine Global. Still to come, SpaceX's AI spending throws cold water on its debut earnings after that blockbuster IPO. We'll bring you the details next. This is Bloomberg. Welcome back. You're watching Insights. SpaceX shares closed lower in late trade after disclosing higher than expected spending on its AI business. Now, this is despite its revenue exceeding estimates in the company's first earnings report after its IPO in June. Bloomberg tech anchor Ed Ludlow has the details.
SpaceX spent a staggering $18.4 billion in the quarter, and the vast majority of that, 86%, was on AI infrastructure. But renting out compute capacity or computing power to companies like Google and Anthropic is becoming a major business, and they gave lots of evidence of that. Second, where is the growth? SpaceX said they will hit $100 billion in annual revenue run rate by the end of this year, and Musk even went a step further, saying they have line of sight, complete confidence that SpaceX will hit $1 trillion of real revenue in 2030, pulling forward a target that they set out in their IPO prospectus. Third, Starship. The next test flight could happen later this month. The rocket's heat shield problem that they had in recent tests is essentially solved, and SpaceX expects to begin launching its next generation Starlink V3 satellites and its first orbital AI data center satellites next year, in that case with NVIDIA compute architecture. Finally, watch out, AT&T, Verizon, and T-Mobile. SpaceX says it's building a hybrid satellite and terrestrial mobile network and believes it can win customers from those US carriers by eliminating dead zones, and the stocks of those carriers reacted sharply during the course of SpaceX's first ever quarterly earnings call. The story is one about growth, short, near, medium term, and long term, but a lot of momentum with SpaceX. This is Ed Ludlow for Bloomberg News in San Francisco.
Well, aside from SpaceX, AMD shares also dropped in late trade after the chipmaker gave an underwhelming AI growth outlook. Its third quarter revenue will come in about $13 billion, missing some of the most bullish estimates. Let's talk about the impact of these results on broader markets with Bloomberg's Anthony Stevens. So, Anthony, how are these results bleeding into the market sentiment with the AI trade? You know, we have both SpaceX, AMD suffering a bit after hours.
Well, let's talk about those companies individually. So SpaceX was actually up 9% going into results. So it's a bit of a retracement of that move. And the move is about half as much as the implied volatility of the stock going into the earnings. So it's, it's still a bit of a coin toss what the market thinks of SpaceX earnings. But what it means for Asian capex is unequivocally very strong, right? They have a huge beat on the AI capex budget, about 20% higher than expectation. They're talking about NVIDIA, a supply lock in. They have very strong metrics around renting out that compute. So across the board, it was a strong result for Asian suppliers. Now, if you move over to AMD, again, some of the stock price reaction has to be put into context with the year-to-date performance of that stock. That stock is up triple digits, much shallower drawdowns than some of the other semiconductor names. So it's up around 140% year-to-date. So an 8% retracement when the earnings fail to clear the best estimates is kind of understandable. They also had very bullish guidance around compute, and that is helping its Asian suppliers and Asian peers. You saw Intel trade about 12% higher into the AMD results. So there's a lot of bullishness in that space. The guidance confirms it, but how the individual stocks are trading seems to be this pattern in the US of good results not completely clearing the biggest expectations and the stocks coming off.
Can we compare this to what's happening in Asia today? Because, we've got a broad-based rally, tech doing pretty well. Take a look at the Kospi up 4%, although, is that just the Kospi-ing?
Look, I think the leads from the overnight kind of earnings and the drop in oil is helping the tech trade, right? The tech trade by nature is a long duration trade. It needs a lot more calm in the treasury market, and we've started to see treasuries calm down as oil's pulled back. EMFX has calmed down as oil's pulled back. And then you have these technology developments alongside a very strong earnings result, right? So Samsung and Hynix both releasing new products, for example. You saw the guidance from AMD on their new products. So Taiwan under the hood, there's a lot of 8-9% up moves. In Japan under the hood, there's a lot of 5 to 7% up moves. So Japan is actually very healthy on the tech front underneath the hood. So it's across the many markets. So yes, Kospi is incredibly volatile, but it's also interesting to note on Kospi, you're seeing a spot up, wall down dynamic. So maybe a little bit more calm going forward in Korea, given the strength of the guidance from the US hyperscalers.
Anthony, just returning briefly to SpaceX and some of the big spending plans we've seen in the share price reaction. I mean, does the market have to remember that this is an Elon Musk company? It's big talking, hard charging, big spending, sometimes loss making. Is that just part of the ride?
Yeah, look, it was part of the ride yesterday as well. I mean, he was on X talking about earnings. The stock was up 9 and now it's down 8. So volatility comes with the Elon Musk territory, and so does this elevated capex. He has big dreams and he's not backing off from that number. And that is the kind of the dynamic that the US equity market has been shifting to, where they're incrementally more concerned about capex than they were. Obviously, the read-through to Asia is just positive, but in terms of investor tolerance for this capex, the first place that pain is going to show up is probably in the CDS market. That will be very interesting to watch tonight.
All right, Bloomberg Markets reporter Anthony Stevens, thank you. Still to come, the RBI expected to hold rates steady, with investors focused on the inflation outlook and any signals on future policy moves. Standard Chartered's Anubhuti Sahay is going to give us her take next. This is Bloomberg. Welcome back. You're watching Insight. Let's take a quick look at where markets stand. Mainland Chinese markets heading out to lunch. Japan, meanwhile, coming back online. It is very much a risk-on day across the region. The Nikkei better by 3% at the moment. Kospi also having a strong day, up by 4%. Those big tech names, SK Hynix, Samsung Electronics, performing well. Bit of a different story in China, though. The CSI 300 still better by 1%, but some tech names like Zhongji, Asalink having a bit of a rough ride. This is after the US decided it would ban Chinese-made or Chinese data service components. A little bit of uncertainty around exactly what that means right now. But generally speaking, it is a positive day, driven largely by the bottom left corner there. Brent crude now below $80 a barrel, 78.46. Optimism on a deal to reopen the Strait of Hormuz. We may hear about that a little bit later on today. Qatar says an interim proposal has been drafted, and both the US and Iran are signaling progress. So quite a lot of optimism around the region this Wednesday. Now, we're also keeping an eye on Indian assets as we await the central bank's rate decision. That's coming in the next hour. The RBI widely expected to keep interest rates on hold as policymakers weigh rising inflation risks from volatile oil prices. Bloomberg's Swati Pandey, who leads our South Asia economy and government coverage, joins us now right here in Sydney. So, Swati, a bit of good news for the RBI today in terms of the Strait of Hormuz as well. Is that going to factor into the decision?
Definitely. The meeting started on Monday, so it's a 3-day meeting, and oil is a big part of India's economy. India is a huge importer of crude oil. 90% of its needs is imported, and a big chunk of that comes from the Middle East. So definitely a big move there. And Governor Sanjay Malhotra has said a few times now that this is a temporary supply shock, and they don't want to react to that. So they would want to see whether any influence from higher oil prices feed into broader inflation and lead to more generalized or broad-based prices, which is not happening yet. There are early signs, but so far inflation is within the RBI's tolerance zone.
Yeah, in the wrong half of the tolerance zone, but within the tolerance zone. But the RBI might be spending a bit of time talking about the weather as well, right?
That's true. So it's El Nino, and monsoon has been weaker. Monsoon rains have been not as good as previous years, and as a result, the sowing season has been slower or delayed. Rains have picked up in recent weeks, but overall, nationwide, they remain deficient still. So food is the largest component of India's CPI basket. So if that starts to feed into food prices, then that's going to be a worry for the central bank.
We have a rupee also, which has strengthened modestly, but it has strengthened. So how much of a factor is this going to be for the bank to consider?
So based on my conversation with our colleagues in India and reading economist notes, it looks like the government and the RBI are pleased with the inflows, the dollar inflows that they have received from non-resident Indians, which was one of the measures they had announced to support the currency. So India has received close to $40 billion in foreign funds from overseas Indians, and this is since June, and that is expected to accelerate further in the coming months. So they do look comfortable. So rupee is not obviously out of the woods yet. It's still one of the two weakest performing Asian currencies. So they will have an eye there, especially with the dollar expected to remain strong. But is that a reason for them to tighten policy? It's not a trigger yet.
All right, Bloomberg's Swati Pandey, who leads our South Asia economy and government coverage. Thank you. Now, joining us now is Anubhuti Sahay, Head of India Economic Research at Standard Chartered Bank. Anubhuti, thanks so much for your time today. As we were discussing with Swati there, the RBI expected to remain on hold. What are you going to be watching for in terms of commentary and the path forward after today?
Thanks for having me. As very rightly mentioned, by you and your colleague, this meeting is not about rate action. This meeting is clearly about what the commentary is, how the tone of the statement is, and what the governor says during his address. There will be 2 or 3 things which we will watch out very carefully. This is the policy meeting where they will give, for the first time, inflation projection for June 27 quarter. Now, this is important because in the last policy meeting, they gave an above 5% inflation projection for December as well as for March 27 quarter. If they see it persisting going in the June quarter, also, then that can be indicative of higher inflation risks. The second thing would be on what they say when it comes about inflation persistence. Last time, the governor was very clear when he said that a spike towards 5.9% inflation in December is temporary, and after that it comes off. But there has to be, we will be watching out in case if there are any commentary which indicates that their sensitivities to upside risk to inflation is increasing, given that supply risks are becoming frequent rather than one-off. We have the El Nino risk, which you spoke about. As very rightly mentioned, there is an improvement, but sowing is low. And the more important part is that reservoir levels are low. And weather is expected to become drier in another couple of weeks. The second is, overnight, we did hear good news around the geopolitical uncertainty as well as on oil prices. But is it here to stay? So, given these uncertainties around supply risks, I think what they have to say will be extremely important to assess if there is any change in their sensitivity to inflation persistence, or do they stick to their word that inflation spike is just one-off.
Yes, forecasting is a challenging job at the best of times, made even more complicated when we're talking about variables like monsoons or the current security situation around the Middle East. So with that in mind, how are you modelling inflation for the coming quarters? Because it is so difficult to predict what might happen. We've had some encouraging news today, yes, but we've been here before, haven't we?
Absolutely. So I think if we look at MPC's forecast of inflation for June 26 and September 26, that has definitely surprised on the lower side. During the June policy meeting, we clearly highlighted that RBI is forecasting inflation at the higher end. And we think they will go and revise down their inflation projection in this meeting marginally. But that marginal downgrade of 10-15 basis points is likely to come with strong hawkish commentary around upside risk to inflation to ensure that the signaling to the market is right. Our view is very similar to RBI in terms of the December and the March inflation trajectory. We also expect December quarter inflation at 5.9% and March quarter inflation anywhere between 5.25 to 5.40. As I mentioned earlier, our view is what would RBI project for the June quarter. Right now, we think it would be, trading closer to 5%. But if RBI projects a number which is higher than 5%, then I think market would become more confident that probably we can see some rate hikes later, if not just as of now. The risk to watch out is if El Nino turns out to be far more intense than what RBI has penciled in its forecast and what we have penciled in our forecast. If that happens, then instead of, say, staying below 6% in the December quarter, if inflation actually surges above 6% and stays there for 3 to 4 months, then the inflation trajectory can look very, very different. And then the rate reaction function also will look different. So I think the risks are far more important to watch out for rather than what the model-based inflation trajectory are saying just as of now.
Where do you place the chances that the RBI ends up remaining on hold for an extended period if inflation risk does moderate?
If inflation risks moderate, then there is a fair, like a high level of probability that RBI might stay on hold. That is our baseline because our inflation projections are very similar to RBI. And RBI and MPC have clearly stated that they want to use the inflation, they want to manage inflation only via a repo rate, as repo rate as the tool. They do not want to deploy repo rate as a tool to manage FX risks or in order to attract capital flow. So they have made this distinction very, very clear, which works well in our view during times of certainty. But during times of uncertainty, we think somewhere if the capital flow story, even if the inflation trajectory is comfortable, if the capital flow story turns out to be weaker, then they might be pushed to go ahead with couple of rate hikes. That's a risk scenario. That's not a baseline scenario. And they can very well coincide it or make it coincidental with higher inflation prints, which are likely to happen in the December and the March quarter.
Where would you place the chances of the RBI lifting the rate to defend the currency? I mean, it's not exactly within the mandate, but it would prevent imported inflation. How likely do you think that is? Where do you see the rupee heading from here, linked to that?
Yeah, so I think on the using interest rate as a tool to defend currency, when the fundamental problem is inadequate FDI flow, I think that has its limitation. And there I clearly sympathize with RBI's view that hiking rates will not alone contain the pace of depreciation. The problem for India is lack of capital flows on AI theme, higher global yields, etc. And they cannot be addressed just by hiking rates continuously, because debt investment in India is far more limited than equity investment. Having said that, I think, as I mentioned before, our baseline scenario is of no hikes, but we do believe that somewhere rates have to be raised by by 50 basis points or slightly more to disincentivize substituting dollar borrowing with rupee borrowing. That also will help capital flows, even if it is helping at the margin. From a rupee perspective, we are extremely cautious on rupee. The FCNR scheme is valid or runs till September end, and hopefully we have got good flows till now. We'll keep on getting good flows, but once the September deadline is over, the momentum in capital flows is likely to weaken, and that is likely to bring back focus and would weigh down on rupees. So our year-end forecast is 96, but we do see risk of it trading at a much weaker level than what we are forecasting because of uncertainties on oil prices, plus, and the most important part, on lack of visibility that capital flows to India, whether it is through the portfolio investment channel or the FDI channel, would turn around in a big way over the next 6 to 12 months. The key thing to watch out here is if government and the RBI come out with another set of measures to attract capital flows. When they announced this whole scheme on June 5th on FCNR and commercial borrowings, etc., both the finance minister and the RBI governor highlighted that there are more measures which are being considered to bring in capital flows onshore. Till now, we have not heard anything, and it makes sense because money continues to flow in. So if they announce something more substantial, then the story can be different. But based on information which we have as of now, we remain cautious on rupee and see rupee trading at a weaker level going forward by end of the year.
To what degree do you think the RBI is going to have one eye on the Fed as well? Because, for now, there's still an expectation we'll see some tightening from the Fed before the end of the year. Do you see that influencing the RBI going forward in any way?
I think, it would depend a lot on whether Fed hike, like the whole context of that Fed hike. If Fed hikes by just 1 or 2 times, and it coincides with lower inflation, easing capital flow pressure on, easing capital flow pressure coming to India, then the need to hike might not be there. But if it coincides with higher inflation trajectory and continued pressure on capital flows, then I think RBI would definitely react to it. So it would depend a lot more on the context. But as I mentioned earlier, I think the baseline or the best case from the Fed's perspective, and that is what our house view is, that they will not go and hike rates. But even then, even if they're not hiking rates, the US Treasury yields are trading at elevated levels, and that is a challenge to get capital flows back in the country. So we do we do see a risk that RBI might use the opportunity when inflation is higher to just give a couple of rate hikes just to ensure that some capital starts flowing in as it becomes less attractive to substitute dollar borrowing with rupee borrowing. This is a risk scenario, not the baseline, but hopefully, we can see something on that front going forward from a medium-term rupee support perspective.
All right. Anubhuti Sahay, Head of India Economic Research at Standard Chartered Bank. Thanks so much for your insights today. Now, we're about 40 seconds or so away from the open in India. It is, of course, RBI Day, and as we discussed there, no change expected to the cash rate or the repo rate, expected to remain on hold, 5.25%. Now, we had a pretty good day yesterday. Here you're seeing the pre-market, actually. Sensex up 0.8%. We did close down a little bit on Tuesday to the tune of about 0.6%. Reliance, one of the heaviest, suffering some of the heaviest losses. That stock down about 2.1%. We've seen a bit of weirdness towards the close in India as well. There's a new closing auction for stocks with derivatives contracts, which has replaced the old way of calculating the official close. We saw some pretty sharp spikes on Monday and Tuesday at the close. The NSE, though, saying that the auction mechanism is expected to mature and increase with time. Got a couple of stocks reporting today as well to watch out for. Pharma stocks, Biocon and Aurobindo among those reporting. Also, the Indian government share sale and Life Insurance Corporation is going to be opening for retail investors also. All right, still to come. Pakistan fintech group Abhi gears up for the IPO of its microfinance bank as it looks to boost its capital base. Our exclusive with its co-founder and CEO, Omair Ansari, is up next. This is Bloomberg. Welcome back. You're watching Insight. Pakistan's Abhi Microfinance Bank is gearing up to launch an IPO this month. It's aiming to raise as much as $11 million as it seeks to capitalize on the country's busiest year for listings. The bank is targeting investors from Pakistan as well as other emerging markets. Let's get some more on the company's expansion plans with Omair Ansari, co-founder and CEO of Abhi. Omair, thanks so much for your time today. I'm just wondering if we can start by getting you to tell us a little bit more about the IPO. Have you got a date yet, and why now? How do you see Pakistan's current market setup supporting you?
Good morning, Paul, and thanks for having me on. So for us, we believe this is the right time to be looking at raising capital in the local market. It's been a stellar year for the past year, as well as 2 years in Pakistan when it comes to the capital markets in Pakistan. And for us, shoring up our capital base and being able to raise capital domestically is very important for us to continue our growth story. We anticipate that by early September, we should be listing the company. The roadshow has already begun, and the book building will begin closer to the end of the month.
So you got about 14% in new shares offered, which is a pretty small float. So what's the intention here? You're trying to maximize control, and how do you balance that against investor appetite?
Absolutely. So to put it in context, we're the first fintech or even tech-backed company to actually list in Pakistan. If you look at the makeup of the index, it's predominantly old school companies in traditional banking or textiles. And so for us, we want to be able to make sure that we are, one, allowing the public to understand what a tech-based company actually looks like, participate in its growth trajectory, and over time, we can start looking at opening up our free float even further. But it's an educational journey as well for the investor here in Pakistan. So for us, we're saying, take a look at what we've done so far, come and be able to participate at the beginning of the next leg of our journey. And along the way, we'll be able to create shareholder value and show that beyond the traditional sectors, there is a growth story in the underlying economy.
So investors are going to be buying into a microfinance bank subsidiary. You know, the main company's not part of this listing. So how do you persuade investors to price Abhi Microfinance as a high-tech growth disruptor rather than like a traditional bank?
So we, to put it in context, again, we had acquired this institution just over 2 years ago. And essentially, our DNA is backed by tech-based VCs. So we have Y Combinator, VEF, Speed Invest, which are all international large tech-based fintech specifically focused venture capital firms. And we've built our company with a very tech-first strategy. And so our acquisition of the bank allowed us to really turn around operations. This bank was losing money hand over fist for about 5 years prior to us taking it on. Within 6 months of us taking over the asset, we've been able to turn it profitable. It's growing. And we believe that our tech DNA allows that to happen. So our cost income ratio now mimics what you would see from a traditional digital bank in other markets, like a Nubank, a Kaspi, for example, which you would not see from a traditional bank in an emerging market. So for us, really, the focus is saying that though this may be a subsidiary of ours, it's our main asset in Pakistan. It is being run like a digital bank. It is a digital bank for everything that we focus on. And so we believe that this is truly our main asset that we will be able to build into being one of the largest digital banks in the country.
Now, part of your journey towards profitability was, closing some unprofitable, loss-making branches. You digitized operations as well. Can you tell us about some of the other lessons you learned on that journey and where you're looking elsewhere to cut costs?
Yeah, look, so for us, as you mentioned, it's very important to be able to start looking and feeling more like a digital bank, which meant that do we need an extensive branch network across the country, which I think is archaic when it comes to emerging markets now. And however, you do need a omni-channel presence. Pakistan's still not the stage where you can go fully digital and fully mobile. And so to build up the liability side of the balance sheet, it's important for you to have physical presence. Kaspi has done this in Kazakhstan. Nubank's done this as well in Brazil. And so does Ant in China. So for us, we believe that really the focus needs to be and has been, one, cutting your overheads when it comes to the unnecessary branch network. Second is automation of your operational infrastructure through the likes of essentially using blockchain technology for us to be able to control our ledger, as well as be able to push more transactions through with a smaller amount of teams on reconciliation, et cetera, and start providing other digital products when it comes to lending to the underlying customer base, so our ARPU starts increasing. So if you look at our underlying financials now, we look and feel much more like a digital bank than a traditional bank, and there are a lot more levers of growth for us to be able to pull through to bring our ROE much higher than where we are today.
All right, so Omair, thank you so much for joining us today, and all the best with your IPO. That's Omair Ansari, co-founder and CEO of Abhi. All right, before we leave you, let's just take a look at how Asia benchmarks are tracking. It is a broadly positive day. We're seeing green across the screen. The MSCI Asia Pacific better by 2.25% at the moment. The Hang Seng Index also pushing higher. A lot of this rally being driven by tech as well. We're seeing SK Hynix, Samsung Electronics having a very good day in South Korea as well. The Kospi pushing higher by about 4.25%, although that index has been subject to some impressive volatility in recent weeks, as you know. All right. We'll just bring you some pictures now, live shots of President Trump. This is, of course, what's been driving a lot of the optimism, is some hopes that we will see a deal to reopen the Strait of Hormuz. Qatar says an interim proposal has been drafted. Let's listen in.
Party, the Communist of America Party.
Republicans have
I think they should have a new party.